Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Renewi PLC stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Renewi PLC is a waste management company operating primarily in the Benelux region. Benelux is a common term used to reference Belgium, Netherlands, and Luxembourg. The acronym PLC after Renewi stands for Public Limited Company, which is the UK equivalent of a US corporation. All of the companies listed on the London Stock Exchange are PLCs. The company is headquartered in Milton Keynes, UK, and was founded in 1880. Milton Keynes is 50 miles northwest of London, or 80 kilometers. The ticker trades on the OTC, Deutsche Börse, Mexican Bolsa, BATS, Euronext Amsterdam, and London Stock Exchange. Let's get started with the model. This is a small cap company, 700 million market cap. They're trading at €9 a share, and they have 80 million shares outstanding. We're going to look at the ticker that trades on the Euronext Amsterdam, since the company reports their financials in euros. If you live in the US and want to trade this stock, the ticker is SHMCF. But not all websites allow you to trade OTC. I know E-Trade does, and Robinhood does not. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 2019, positive after that. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative in 2019 and 2020, positive in 21 and 22. Revenue is a sales for the company, and that's fairly steady. It goes from 1.78 billion euros to 1.87 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that looks good. It grew from 259 million to 357 million. Below that is our operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that was negative in 2019 and 2020, 43 million euro in 2021, and a triple to 124 million euros in 2022. They received 9 million of interest on their investments. They paid 35 million of interest on their debt. They paid the most in 2020, 40 million. They have 3.4 million of financing costs. Their pre-tax income is 96 million, 20 million in taxes, and the bottom line of the income statement is their net income, which looks really good in 2022 at 75 million euros. Much better than 2019 and 2020, which was negative, and 600% higher than 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They do generate positive operating cash flow each year. The reason their income statement is negative in 2019 and 2020 is because the income statement has a lot of non-cash items, like depreciation and stock-based compensation, but the statement of cash flows eliminates those accounting items and just reports cash. They spend a decent amount in CapEx. These are investments in property, plant, and equipment. They spent 86 million in 2022. It was the most in 2019, 108 million. Operating cash flow minus CapEx gives you your free cash flow. They did have negative free cash flow in 2019, but it was positive after that, highest in 2021 at 176 million euros. They did add some debt in 2019, 40 million euros, and 150 million in 2020. They did pay down 100 million in 2020, so they increased their debt load 50 million. But they paid down a lot of debt in 2021, 274 million. They also paid down 50 million of debt in 2022. Let's look at the capital structure. 331 million of equity, 668 million of debt. They're 33% equity, 67% debt. Their net debt is 606 million. And their WACC on Finbox ranges from 9.5% to 11%. I use the middle one of 10.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.3 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of 1.1 billion euros. We divide that by 80 million shares. And we get a calculated stock price of 14 euros. They're trading at 9 euros, so they're trading at a 38% discount. It's a buy according to the model. Their revenue forecast for 2025 is 2.1 billion euros. For 2024, it's 2 billion. And for 2023, it's also 2 billion. I continued this growth into 2026 and I got 2.2 billion. That's how I got their future revenue estimates. They convert on average 4% of their revenue into free cash flow, so I multiplied their future revenue estimates by 4%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 1883. They're saying it's 54% undervalued. This is where the stock has been trading since January 2020. And you can see it got close to 2 euros in the middle of 2020. Then at the end of 2021, it got close to 10 euros. It dropped to 7. Then in the past few months, it's jumped back up to close to 9. And when you see a green bar at the bottom, that means the buy orders are higher than the sell orders, and the stock price goes up. When you see red bars, that means the sell orders are higher than the buy orders and the stock price goes down. So that's pretty much how stock prices move, simple supply and demand. The more people willing to pay for the stock, the higher it goes. The less people willing to pay for the stock, or the more people that want to sell the stock price goes down. And this S means they did a stock split. On July 19th, they did a 1-for-10 reverse stock split. So it looks like it was trading at about $6.50. Say you own 10 shares on July 18th. You would have had 10 shares at 0.65 euros. Then on July 19th, you would have had 1 share at 6.5 euros. Companies usually do reverse stock splits so the stock price is above $1, or in this case, 1 euro. A euro is pretty much a dollar, because 1 euro equals 1.04 US dollars. That's usually not a good sign when companies do reverse stock splits. They do that so they stay viable and they don't get delisted. Because a lot of big funds won't buy stocks that trade below a certain price, like for instance below $5. It looks like they were paying a dividend before 2020. The yield was as high as 7.5%. Then they cut their dividend, likely due to COVID, and they haven't paid one since. But the forecast is for the company to bring back its dividend this year, and the yield is expected to be as high as 2.1% by 2025. They have a beta of 1.52, so the stock moves 1.5 times the market. It's a bit volatile. It's gone up 31% in the past 52 weeks, while the S&P is down 12%. 52-week low is 6 euros, the high is 10. The stock is trading above its 50-day and 200-day moving average. Only 30,000 shares are trading each day on the Euronext Amsterdam. Of the 80 million shares outstanding, 74 million are on float and half the shares are held by institutions. At least the CEO is making good money. Their annual salary is 566,000 euros and their total compensation package is 2.7 million. It's up a lot in the past 12 months. 80% of the company is held by institutions, 12% by the general public, 6.5% by private companies, and 1.3% by individual insiders. Their employee count went up a lot from 2016 to 2017. That could be from an acquisition, and it's been fairly steady since then. They currently employ 6,600 people. Here's a list of their top 10 biggest shareholders. Paradise Investment, 5.5%, Spice One, 5%, BlackRock, B of A, Avenue, Janus, Dimensional, Citigroup, Robco Sam, and Saxo Bank. The best way to look at ratios is to compare them to companies in the same industry. There are 19 companies in the same industry as Renewi, and if Renewi has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. I converted Renewi's numbers to US dollars since the other tickers trade in the United States. They spent less than average in CapEx. Their debt to equity ratio is 2, average is 1.6. So for every dollar of equity, they have $2 of debt. Their free cash flow is lower than average. They rank 10th in market cap at 727 million US dollars. The average is 8.7 billion. They have really good price multiples, a PE of 9, price to free cash flow of 7, and price to sales of 0.4. They generate less revenue than the average company, but a lot more revenue as a percent of their market cap. And they do have a positive ROA and ROE. Lots of companies in this industry have a negative. To summarize, I have them trading at a 38% discount, and this company has a really long history. So I think they should be fine on a long-term basis. And I think it's pretty likely they're going to bring back their dividend. So that should be helpful too to a lot of investors. And they do seem really undervalued according to their price multiples. A PE of 9.3 is amazing. I rank their free cash flows 5 out of 10, their revenue 6 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.